So what's the difference between you and a Wells Fargo?
Besides, I answer my phone all the time.
Oh!
Not really.
I feel like you've been chomping at the bit to make content. You're ready for it. Hi, my name is Fernando Rivera, and I am your GBF Realtor of Austin, Texas. I am here with...
Justin Gerard.
And you are with...
I work with New American Funding.
Which is...
a retail mortgage bank, so it's not like going to your
Wells Fargo or
yeah.
Chase or...
All we do is mortgages. We don't do any deposits or anything like that.
So what's the difference between you and a Wells Fargo?
Besides, I answer my phone all the time.
Oh!
Not really. There's really not much difference.
Mm-hmm.
It's how we conduct business. I mean, maybe the interest rate might be a little different. We're doing the same thing. I think the biggest thing is, do they answer their phone? Are they helpful? Do they make you feel comfortable?
Yeah.
Like in talking with? Because that's the biggest thing is we're creating a relationship, and we're going to be friends probably for a long time.
It's a triangle of trust between the lender, the realtor, and the client.
Always.
You need nothing but complete honesty, because otherwise things pop up and your loan will take longer to close, or it may not happen at all. You may not reach that approval. The underwriter might find that there's a skeleton in your closet that you haven't disclosed, and everything is just poof, goes away.
I used to underwrite for 15 years. So I know all the tricks.
An underwriter is essentially like they're the people behind the scenes of the loan officer.
We're the gatekeeper.
Yeah.
We're the one who says yes or no.
Okay, so you work with New American Funding. Right now I want to just get into the basics because we did a Mortgage 101 video earlier with another lender with Benchmark. And so I want to know, what are the basic types of loans that are offered out there to home buyers?
Your conventional loan, your VA loan, USDA, and FHA. Now let's kind of break down
the top four.
One.
Yeah.
Top four. The first one, conventional.
Mm-hmm.
I like to explain this to clients, customers, anybody, that it's your standard loan. It's kind of like what you're going to see on Zillow or Realtor.com when you're looking at, oh, hey, this is your payment.
The little loan calculator.
Yeah.
They're just like, and that's another question that I want to ask is how accurate those are on those websites.
Those calculators or those payments you're seeing online, what you'll notice is there's no mortgage insurance. So what they're assuming is that the client's like, you're going to put 20% down. Mm-hmm. Because there's a lot of things that go in to determining what your mortgage insurance payment is.
Yeah.
Little down payment, what's your credit score, what's your debt to income ratio. Those three things right there are huge in determining how much mortgage insurance you're going to pay.
And also, I'm assuming those don't take into account the sliding scale of taxes.
Yeah. Because
taxes change every single year. Unless you protest them, they go higher, because normally cities want to make more money off of your property. So that's not factored into, on top of the private mortgage insurance, what those little sliding calculators spit out, which is why it's important that even though you may have that sliding calculator, it's not going to give you this most accurate information as if you went straight to the source and asked a lender, what am I really going to pay over the life of this loan, first year, second year, third year?
Yeah, I mean, that's why it's really important before you start home shopping, or even just reaching out to an agent who's going to take you home shopping. Talk with the lender just to figure out what you're pre-approved for, right? That's the biggest thing you could do that's advantageous to help you get across that finish line.
Right. And that's the first thing we do with buyers is that we sign buyers, and the second we get them signed, we want to make sure, have you spoken to a lender? You haven't? Great, awesome. I'm going to send you to a lender, because if the lender is not showing any evidence that they are capable of actually affording the house that they want to buy, then we're jumping the gun, taking them shopping when they haven't even sorted out their finances yet.
Yeah. Well, what we're doing really is we're creating a disservice to our client, because they're going to go look at a $500,000 house, fall in love with it, apply for it, and find out they're only qualified for $250,000. So you've just kind of like crushed their hopes of owning this beautiful home that they found to like, hey, look over here. And it's like kind of going shopping, right, for your car. I want this brand new 2025, but you really can only afford the 2010.
Yeah.
But back to what we're talking about, conventional loans. All right. So when it comes to the conventional loan, it's your standard loan. And the down payment on that, you do not have to put down 20%.
Yeah.
You can put down anywhere from 5, 10, 15, as much as you want. But the thing is if you don't put down 20%, like we were just talking about, mortgage insurance, you're going to carry that.
PMI, private mortgage insurance.
Yep. And then also, credit score. Conventional loans require at least a 620 credit score. So if you have something that's lower than that, that's totally fine. What we're able to do is we don't just send you to credit repair. We have ways of doing a credit simulation and set you up with a game plan of, hey, if you do A, B, and C, I can get your score from whatever it is here to at least a 620. And then it just gives you a game plan. I think that's the biggest thing we could do for all our clients. If you don't qualify now, what are the steps to get you there?
Yeah, and one thing also, 620 credit score minimum for conventional loan. It's not just for conventional loans. I've been trying to get clients into leases and they have below a 620 credit score, and a lot of landlords and property management companies won't even let you rent if you're below a 620 credit score. So all this plays an important role, not just in buying a home, but if you're not quite ready to buy a home and you want to lease a home, that's also something that you have to take into consideration.
Yeah. And then the third thing would be debt to income ratio.
DTI.
DTI. You always hear that acronym.
Yes.
Now, the way that works is you're going to get all your debt, right? Even include your new house payment. Get that plus anything that might be on your credit report, student loans, credit cards, cosign debt, little things like that. Add all that up and divide it by your gross income, right? Not your net, what's your gross. Conventional is going to stay about 49%. You want to be 49% or below. Sometimes there's other compensating factors that'll help you get approved, but that's the number.
So it pretty much means that however much money you make per year, half of that has to be your profit.
Yeah.
To have, a debt to income ratio that meets the requirements of 49%.
Right. Those three things, your down payment again, your credit score, and your debt to income ratio are the big three factors that kind of determine what your mortgage insurance is going to be. Now with conventional, there's no upfront cost when it comes to mortgage insurance, like say FHA, which has the upfront MIP. Now
that's their version of private mortgage insurance. It's MIP for FHA loans. So if you hear them, MIP and PMI, they're kind of interchangeable in that they're that extra premium you pay for not quite paying as much as you should up front.
All right. So say somebody has a 750 credit score, their debt to income ratio is 44, and your down payment's 5%, right? You might have a 0.2, 0.3% factor for your mortgage insurance, which is low. Now let's go on the opposite side of the spectrum. Let's say you have a 630 credit score, debt to income ratio is 48, and you put down 5%. I've seen it be at 2%. So that's
instead of 0.02.
Yeah, but then that's where your loan officer that you're working with might suggest, hey, let's consider FHA, which we'll talk about second.
Yeah.
And because that mortgage insurance premium is going to be much lower. Now let's move to FHA.
And FHA stands for
Federal Housing Administration.
Okay.
Now it's a bigger box that more people can fit in. Okay. I say that because number one thing is your credit score and your DTI, right? The credit score, they'll go down to 580.
Okay.
Now we also can go down to 500, between 500 and 579, but you have to put a bigger down payment down.
Okay.
10%. But typically FHA, 3.5%.
Okay. That's a big difference.
That's
3.5% and 10%.
Yeah.
So those little numbers in your credit score can mean a huge difference in what your down payment can be with an FHA loan.
Yeah. Debt to income ratio, 59%. Like if we have good compensating factors like assets or things to kind of make your file look a little stronger, then it'll go up to 59%, but between 55-59% is that ratio. That's how it's a bigger box.
And what are those assets that can help you?
Retirement accounts, savings accounts, money markets, like anything that you might even get a gift from your family. That can help be used.
What about a car?
No, you're not gonna put on there just like you have an auto, like a Ferrari, right?
I mean, you can sell that. You can. It's liquid.
If you sell it, like that's a good point. Like if you decide to sell anything, here's another thing: you want to make sure you have the bill of sale. You want to know what the value of that is, right? Go to Kelley Blue Book. Like we got to show, like, hey, what you sold it for is it what it's worth. So it's little things like that, the underwriting experience, right? That helps get you set up for success. Now, lastly, mortgage insurance. So on mortgage insurance for FHA, there's the upfront MIP that you mentioned earlier.
Yeah, mortgage insurance premium.
Right? That's 1.75%. I want you to think of this, it's what insures the lender in case you were to default, they're gonna pay. I like to explain it to people is you gotta pay to play, right? So they're gonna pay 1.75%, but it doesn't come out of your pocket. What it does is we just roll it into your loan amount, okay? That's the first thing. Now the second thing with your mortgage insurance on FHA is depending on how much you put down. If you put down 5%, you're gonna pay 0.5% on monthly MIP. And then if you put down 3.5%, anything less than 5%, it's gonna be 0.55%.
Is it just those two set numbers?
Yeah. Yep, just those two set.
Okay,
So even if you put down 15% on FHA, 0.5. Here's another thing. It's for the life of the loan. Like even if you
Oh, so you can't get rid of that MIP.
if your equity goes down, you're still paying as long as you're in that loan. But say you refinance to a conventional, we'll get rid of that mortgage insurance as long as you have 20% in equity.
Yes. So once you're in your conventional loan, let's say you had private mortgage insurance because you didn't make that 20% down payment. Once you reach 22% of equity in that conventional loan, your mortgage insurance goes down or gets eliminated. With FHA, it's on there for the life of it until you finance into a conventional.
All right.
Okay.
All right. And then third one will be USDA. So USDA, I like to describe this program.
I think of beef. Like it's a meat, it's a cow, it's a farm loan. Like
Yes.
that's what I think of.
That's what I tell people too. I'm
Yeah.
like, hey, look, it's not your loan that's just out for the country, like, right? You're not outside the city limits. Like there's pockets in certain areas. Leander, I know there's like a pocket that is eligible for USDA financing, right? But
Is it because they're just so underdeveloped still?
Possibly.
Or, okay.
But here's the thing. I always tell all my clients, again, because I share all this stuff to be transparent, because we don't want people to be blindsided, right? And we're going for a mortgage. Is you got to meet two requirements when it comes to USDA. The first one is the property in an eligible area.
Okay.
Okay. And it's real easy. You can go to USDA.gov, but I can do that for you. And you just type in the address, and it'll tell you if it's in an eligible area or not.
Kind of like you're typing in your address into FEMA
Exactly.
for a flood zone.
Exactly.
Okay.
Then the second thing is, once we check that box, we're going to go to the second one. Do you meet the income limits? Now, each county is different on what the limit is, okay? But here's the thing. On USDA, they're going to use total income to see if you qualify for that program. What I mean by total income is it's not just me who's on the loan, or anybody, your spouse, or anybody else is on the loan. Anybody who's 18 and over, living in that house and working, we're going to include that income on your income to see if you meet the income limits.
So if you have your 18-year-old kid working at McDonald's, you're going to pull his income in.
Exactly.
Okay.
Yeah. So it's little things like that of how to navigate these loans. Can we make it work?
Okay.
So say we meet the income limits. Check that box.
And the USDA limit is?
It's different for each county. Let's do down payment first. There's no down payment requirement.
For USDA?
Yeah, it's 100% financing.
Okay.
Right? But here's the thing.
It's almost like a VA loan.
It is, but
there's
see,
no-
a lot of people are like, hey, I want my payment to be here.
Yeah.
But if you don't put no money down, your
You're
payment's
not
going to be
get
higher.
that payment there.
Yeah, it's going to be
Okay.
higher. You have no skin really in
Yeah.
the game. Now, the credit score, 580. You want to have at least a 580. But to make it more streamlined, if you're in the sixes, it makes it a little more easier, because maybe we get a manual underwrite, which is just more questions, right? We got to provide more documentation. It might be tougher to get a loan. Okay. USDA is not for everybody. Again, we saw that, right?
Yeah.
Is it in an eligible area, or do we meet the income limits?
Yeah.
Now, also, there's the debt to income ratio. This is huge, 43%. As soon as you start getting over that, you're not going to get an approval. Again, it's not for everyone.
It's not as flexible as a conventional is.
Yeah, it's black or white.
Okay.
Do you meet it or not? Now, we can get exceptions made sometimes, but a lot of times when you're running these findings, like the automated underwriting system findings for these programs, once you start to give above 43 for USDA, we're not going to get approval. Now, with mortgage insurance on any government-backed program, right? USDA is another one. You also have that upfront cost, but USDA calls it the guarantee fee, right?
See, I'm not familiar with USDA loans, so this is actually very new to me. I've never heard guarantee
It's
fee.
upfront MIP.
That was not on the realtor test, I will tell you.
Right? It's the upfront MIP that FHA charges. They just call it the guarantee fee.
Okay.
Now, that amount, though, 1%.
Okay.
Okay.
That's not terrible.
It doesn't come out of pocket.
Yeah.
We just roll it into your loan amount. Then they also have the monthly mortgage insurance you're going to pay, 0.35%. Yeah, you don't have a down payment, but you still have that mortgage insurance. So now you kind of see how your payment might be a little higher.
Yeah.
And man, once you go above the 43% debt to income ratio, it's hard. Hey,
Those-
USDA can be a great tool to help you
Yes.
get in a house. Don't think that you're not eligible for it. Unless you just talk with the loan officer and just go over these options, how do you know?
And also, it's really important for you to know, as realtors, we can give you suggestions and we can kind of guide you in the right direction by leading you to a loan officer, but we are not loan officers. Like, we do not have the knowledge that people like Justin have. Talk to an actual loan officer. Don't get all of your loan information from your realtor, because again, we're not certified the way that they are.
I like to tell people as I'm working with them is think of the agent as they're the face of the whole transaction. They're working with the client. They're helping them negotiate to help them get their offer accepted. The loan officer, they're the money person.
Yeah.
They're the ones behind the scenes making the deal work. You know, we might strategize. I'll be like, Fernando, this is what we need to do. We need to ask for A, B, and C in order to get our borrower across the finish line. I rely on the agent to go negotiate that, and hopefully they agree to those terms.
Yeah.
This is something that I'll pull out of my back pocket with people. To help agents win deals, right? A good loan officer is gonna call the listing agent before that offer's sent, or maybe it's just been sent, and give them a comfort call. The comfort call goes a long way because you're letting the other side know, hey, I've already vetted my borrower, I've already got him qualified, and this is 100% gonna close. And when that listing agent hears that they're guaranteed to get that paycheck in 30 days, what offer do you think they're gonna accept? If the other lender didn't do a comfort call and I did, I think we're gonna stand out and they might choose us. Whatever we could do to make our offer look better, let's do it.
And one thing that a lot of people don't understand is that the people on the other side of the transaction, you know, the lenders, the title people, the other realtor, if they don't work well together, they're not going to do very many deals together. And so it's very important that, you know, you love the house and that it's the house that you want, or that you're pleased selling the house. But if your realtor or your vendor person does not play well with others, then you're probably not going to do very well in closing that property or in having a smooth closing. But I deal with realtors who, you know, are not very communicative. They don't respond well with text messages. They don't answer physical phone calls. They'll follow up like with an email days later after I texted them. I don't want to do business with them again. And it's going to be very hard, you know, to work with clients that want to do business, you know, with their clients, because we know that it's not going to be smooth. I mean, we'll do it because clearly we work for y'all. Yeah. But it helps to have people on the other end that are considerate of the vendors on the other side of the negotiation table.
Communication is key. When it comes to buying a house, you can never over communicate.
Yeah.
Keeping everybody on the same page, whether you're, like you said, agents, both sides, the title, and the borrowers and the lender, if we're all on the same page, by the time that 30 days is up and we're finished closing that loan, crossing the finish line to buy a house, people look back and they're like, Fernando, that's all it was?
Yeah.
That was the easiest thing I've ever done. And that is our goal.
Yeah, it's like you want to get your house, sellers want to make their money, and we want to get paid. Like that's pretty much, that's the circle of life right there. You know, like why would you hinder that?
Yeah.
And so our last loan we have is the VA loan. Okay.
All right. So VA, I love working on my veterans. The VA loan, again, there's no down payment. All right, it's 100% financing. Credit score 580. We'll go down to 500, but you know, again, it's all about compensating factors. How do we make this deal work?
A VA loan is for
veterans.
Okay.
Just
want to make sure. For those of you who don't know, VA loan, like I want one. It's like, well, if you're not a veteran, you can't get one. Yeah. So I just want to make sure.
No, it's for veterans. Yeah. Now, the debt to income ratio. All right. When it comes to VA, you want to kind of stay around 55% or lower, right? But here's the thing: compensating factors, not having a lot of assets or high DTI, low credit scores, things like that. It just changes. What VA focuses on is residual income. Okay. Now, what is residual income?
As an actor, I will tell you, I know exactly what residual income is, but go ahead.
It is what's left over after all your bills are paid. Based on your family size and where you're purchasing and your loan amount, they're going to give you a limit. You have to have at least this much after all your bills. Whether it's what's on your credit report and your house payment, you have to meet that certain limit. Because VA doesn't want their veterans to not be set up for success. They want to ensure that you are going to be successful with home ownership, because again, they're going to guarantee your loan up to 25%. And if we set a veteran up to fail, then guess what happens? VA has to pay for that.
Government's on the hook.
Yeah. So it's little things like that. So I wouldn't focus on DTI, but it's your residual income. Yeah. And that's when you work with a good lender. They're going to calculate that up front and let you know, hey, you're good to go. A good thing is there's no mortgage insurance for the veteran.
That's beautiful.
Yeah. And, you know, taxes. Depending on somebody's, if they have any kind of rating, they can save in taxes. Somebody that might be 100% disabled, like for their rating, they don't pay property taxes.
And their spouses don't either.
Yeah, their whole house, they don't pay any taxes. So think how much purchasing power that gives them.
Yes.
Because taxes are a huge part of somebody's mortgage payment.
What are the downsides to a VA loan?
I don't think there really is a downside to a VA loan. It's giving a veteran who's earned their right to use the VA loan to help them buy a house. When using the VA loan, you want to live in your house for at least a year. If you buy that house and you have what's called bonus entitlement, you can use your VA loan to buy a second house.
And that can be an investment property? Does it have to be a primary residence?
It has to be a primary residence.
Okay.
But the house that you just left, it's now an investment property.
So those with a VA loan capability could potentially be real estate moguls.
I mean, if you know how to use it,
Okay.
it can work.
Okay. So one thing that I want to get into, especially you being here in Austin, what is the most frequent concern of Austin home buyers that you found that come to you?
Working with a lot of clients in the Austin market, I always ask them, what is that max comfortable payment you can afford to pay? They'll tell me their amount. It's game time. I got to go find them a program and help them get that payment. And it's trying to help them get that payment that becomes a challenge sometimes, because somebody might be used to paying what they do in rent, but what they don't understand, when you buy a house, your rent might be this amount that's fixed the whole time.
Yeah.
But when you buy a house, there's 3 things that possibly, in addition to your principal and interest, your loan amount, your insurance, your taxes, and depending on what program you go to, your mortgage insurance.
Yep.
And those 3 things make that payment increase more than what they want to pay.
Have you found where you have somebody wanting to apply for a conventional loan and you tell them, actually, I think an FHA would be a lot smarter for you?
I don't ever try to convince anybody to do anything.
Oh, that's a good answer. That was a trick question.
Right?
So you,
So look,
you
this
got
is
that
the
one.
thing. A good lender is going to present options based on what your initial conversation, how it goes. Hopefully they're answering, hey, what's that max, payment? Second one would be, what's the max cash to close? Like, what can you afford? Like, what do you want to come out of pocket? So as long as you're asking those questions, now you're able to go set them up for success, right? To cross that finish line of home ownership. I'm going to present you with options that align with what you're trying to do. So you got to provide that information to them so they make the decision. We don't make the decision for them.
Yeah, I mean, I can't.
We have to let them make the decision, because guess what? At the end of the day, it's their loan. And when we close, they're going to be so happy that they were part of choosing the loan program that set them up.
Does somebody have to be completely ready to get into a loan to come talk to you?
No, just call someone.
Yeah.
Call me, call another lender, call Fernando. Hey, do you know a lender? He knows 3.
Yeah, I know at least 3. What happened with me is when I was moving back from Los Angeles, I thought I was going to rent, and I found a bunch of places where I'm not paying the same amount of rent that I'm paying in LA to rent this piece of crap. My dad, who is a broker down in South Texas, he said, oh, why don't you meet with a lender and see if you can get pre-qualified? I'm like, Dad, I can't get pre-qualified. What are you talking about? Like, I'm just a baby. And he's like, no, go. And so I went, and sure enough, I was able to get pre-qualified. And I was completely not ready for that. It was just a trip that I made because I happened to be in Texas. Yeah. But that was a surprise to me. And so I know that it can be a surprise to other people if you walked into a competent lender's office and presented honestly, what your financial situation was. You might surprise yourself at what you could be capable of that day or 3 months down the line. And as far as pulling credit when they come talk to you, is that a concern they should have?
That all depends on the lender you're working with. Myself, I always do what's called a soft pull first. We're only going to get 1 credit score out of the 3 credit bureaus. It's a sneak peek of what's on your credit. And it just lets us start to set up your file so we can get it put together and get you pre-approved. How you felt whenever you got pre-approved, you were like, what? I did? Think about all the people out there that just don't know. You're going to continue renting.
Yeah, you are.
Right?
You're going to pay somebody else's mortgage or somebody else's investment property. I said all the wrong things when I went into my appointment for my, my mortgage lender. He was asking me about my income and, coming from an entertainment background. I don't know what I'm going to make the next year. I get surprised when I find out, like tax day, what I made the year prior. We don't keep track of that because we get like 12 W-2s from all these other production companies that pay us money from the projects that we've done. And so he asked me, oh, well, what do you think you're going to make for the next 2 years or the next year? And I go, I don't know. It's really just a crapshoot. And he was like, well, we don't like to use the word crapshoot when we talk to the underwriter. And I said, oh, yeah, please don't tell the bank that. Yeah. And he was like, I am the bank. And I was like, oh, Jesus. Could you just cut? Can we start again? But I was honest with him. And he saw that I was really genuine about being interested in home ownership and that I did have means to pay for it, even though it wasn't conventional and it wasn't as consistent as his other clients. That kind of helps to have somebody who's compassionate and who can see where you're coming from and know exactly what the best program is for you.
All right, look, we were talking about credit and getting it pulled. Yeah. But here's the thing. What I like to do for my clients is I do what's called an opt-out. As soon as you submit an application, I'm gonna opt you out. Now what this means is after 5 business days goes by, I can pull your credit with my client's permission, and your information is not sold. Because here's what happens, is maybe you talk to a broker and they do a tri-merge credit pull, which means we're gonna do a hard pull and we're gonna get all 3 scores, which helps because it's exactly what it is at that day.
Yeah.
But your information is sold by the credit bureaus to a ton of lenders.
Really?
Yes.
I didn't even know that.
Lenders pay big money for that information. Because
Okay.
guess what? When your credit report's pulled, now it's triggered a new lead for all these lenders. They're like paying for these leads. Well, guess what
Sharks.
happens? I've had clients tell me 30 lenders have called them in a day. It's so annoying. And I have to say, did you go talk to another lender and they pulled your credit? That's another thing you want to ask your lender. Are you going to do a soft pull or are you going to do a hard pull? Most of the time, just to get a pre-approval going, just do the soft pull. It's a sneak peek. It's exactly what I'm going to see. I'm just missing 2 scores. You don't want someone calling you all the time asking you the same question, because it could be Steve from ABC Mortgage. Hey, I saw you're looking to buy a house. I'd love to be able to help you. And you say no. As soon as you hang up that phone, 2 minutes later, someone else is calling. Hey, this is Larry with XYZ Mortgage. Can I help you? It happens all the time.
I thought realtors were bad, but lenders are probably just as bad.
Well, they pay all that money
Yeah.
to hopefully get a swing at the plate to talk to that lead.
And that's also one other thing, that when you become a homeowner, you're going to get emails and you're going to get mail from every single type of home warranty place. And it'll look like it's on behalf of your lender. It's not. It's a lot of people who just discovered you just bought a home and they're trying to get as much money as possible out of you. Or they'll say, oh, your home warranty is expired, pay to renew it. I'm like, I didn't get a home warranty. Like, what are you talking about? Your information is instantly sold once you buy a house, so be prepared after that to get a lot of junk mail that's going to try to make you believe that you owe money or that you have to pay money in order for your house to stay well maintained.
You'll get something like, hey, your warranty is expired and it's been a week since you've closed, but your agent, who's awesome like Fernando, he's going to negotiate the seller paying for your warranty, and you're like, I have this for a year and it's already expired.
Yeah, scare tactics.
Yeah, but you're going to get mail from someone and say, hey, let me file your homestead exemption. Just pay me $200.
And all you do is go online and just tick off a box, and that's your homestead exemption.
Yep. So working with a good team that just knows these ins and outs of the home buying process will set you up for success.
So now, down payment assistance, because that is something that is key. Because in my head, I think down payment assistance, I'm taking out another loan. It seems like it's too much. Is a down payment assistance something that people should actually consider? Overall, what's the biggest benefit of that?
Good question. So down payment assistance is a great resource. I always like to tell people, keep it in your back pocket and pull it out if you need it. 2 things I like to describe about down payment assistance is, first, it's not free money. All right. And what I mean by that is you're going to probably have a higher interest rate than if you did a traditional, conventional FHA loan. But that's how they keep the program going, is through the interest rate. And the second thing is, depending on what you kind of assistance you get, because there's a grant, which you never have to pay back, but your interest rate might be a little bit higher, or there's a 3-year forgivable second loan. But let's just say you go that route. Well, you're locked in that loan for 3 years. So if somebody were to, get a promotion at work a year and a half into being a homeowner and they got to relocate, well, once they move and they sell that house, they have to pay back a portion of that down payment assistance. Or, hey, the rates drop. I can't call my client and say, hey, let's refinance to help save you money. Because if we refinance, we're gonna have to pay back that down payment assistance. You're in that loan for 3 years. So I always wanna make sure you're aware of how it works. It's a great tool. You can get some really good rates. A good lender is gonna be able to look at all different programs when it comes to their client. But this is a good trick, right? An agent that can help negotiate seller concessions will stack it. And now what I mean by that is you're gonna get the down payment assistance to cover that 3.5% down payment, hypothetically FHA.
Yeah.
Covers your down payment. Then your agent negotiates seller concessions.
Which means that this money that the seller will throw in to the buyer to help facilitate the deal.
Yeah. Then guess what happens? We stack those 2 things. Now your cash to close could be way lower than you think. to buy a home.
And one thing that a lot of people don't realize when they're buying a home, you know, I have clients specifically that were telling me about, well, this house next door sold for this much and this house sold for this much. And I go, yes, that's true. But they also had a $50,000 seller concession to the buyer. So the price that you're seeing that they sold it for, subtract another $50,000 from that price, and that's how much money they walked away with. So the price may seem one way on Zillow if you see how much the house sold for, but you have no idea what happened on the back end, which are these seller concessions that were used to facilitate the deal so that the buyers and sellers could be happy.
On my company, New American Funding, we will go below 620 with down payment assistance, whether it's for conventional or FHA, USDA as well. But until you reach out to Fernando or myself to see, do I qualify? You're never gonna know.
And it's like, hopefully you've got enough information from this to where you're a little bit less intimidated to ask questions. And even if you ask the same questions, it doesn't matter. Like, we're not here to judge, we're here to educate.
Yeah.
So one of the main reasons why I try to make these videos is because I want to answer the questions people feel they're too dumb to ask.
Yeah.
And there's no question that's too dumb to ask when you're a complete newbie in this world. Like, I'm finding out things about real estate that I never knew, and I took all the classes. And I'm learning things every single day. But unless you ask and you seek out information and content, you're not gonna have the confidence to take that step for yourself. Well, let's drop it here, because then we're gonna get way too complicated. But like, I would love to talk later about discount points, you know, things like that, because these are all things that are tossed around in deals and people have no idea what they mean. But until next time, how can people get in touch with you, or how do you prefer people get in touch with you? Through a realtor, through just checking out your website? What's the main method?
Well, if you're working with an agent, you know, what I like to do, ask them to do, is just shoot me a text message and just do an introductory text. And I'm gonna set up a time for us to get together. If you not working with an agent, you can reach out to me. Again, it's Justin Gerard, JUSTINGERARD. And my phone number is 512-653-2652. I always answer. If I'm on the phone, I'll call you back. But as soon as I'm off, I'm gonna call you back. But use that phone number, shoot me a text message, and I guarantee you I will reach back out to you and answer questions that you have. That's the biggest thing that I think a lender could do, is just make their client feel comfortable, because it is the biggest.
And they are the money, but they are not a bank. So they're not only operating from 10 to 5, you know, Monday through Friday.
Yeah.
Like when you're in the middle of a deal and you have to get in touch with your lender, they will answer and they will respond to you. A good one will. Thank you all for watching. I'll have Justin's information on here so you can reach out to him, or you can reach out to me. I can connect you to him, whichever way possible, as long as you're taking the steps to educate yourself. Yeah. So my name is Fernando Rivera. I'm your GBF Realtor of Austin, Texas. And I do this because friends don't let friends shop alone. We're done.
Thank you. Yeah, that was fun.
That was fun.
What'd you think?
That was good. It was good.